Hello, in this video we are going to look at a problem together. This is a problem that starts by giving us a beginning trial balance, and then they provide us with some information about the transactions that occurred during the month. And we are going to journalize all of these transactions and prepare an ending trial balance. So we're going to look at these transactions one by one. You'll notice what I have over here is just a simple chart of debits and credits. Anytime you are preparing journal entries or, given a problem where you have to journalize transactions, I always recommend having open some sort of debit and credit chart. This makes it really easy for you to remember how debits and credits affect different accounts differently. So what we're going to do is we're going to go through these transactions one by one. All right. So here again, we start with our beginning trial balance, and this is the balance at June 1st. Okay, so now let's look at what happens during the month of June. So on June 4th, the company borrowed cash from the community bank by issuing an $1,800 note payable. Okay, when we are journalizing transactions, all right, we have to remember that every transaction is going to affect at least two general ledger accounts. We're going to have at least one debit and at least one credit, and total debits and credits must be equal. Okay, so with that in mind, let's ask ourselves what happened on June 4th. Basically, the company borrowed money. Okay, so their cash account just went up by $1,800, and their liability in the form of a note payable also went up by $1,800. So now we need to journalize this. All right, well, we know that cash is an asset account. Okay, their cash just increased by $1,800. So we go over here to our chart and we say, okay, what does it take to increase an asset account? Well, we have to post a debit. Okay, in order to increase a cash account, we're going to have to post a debit. So we look down here and we have a debit to cash for $1,800. Okay, now we also need to increase our note payable account. Note payable is a liability. How do we increase a liability account? We post a credit. So we are going to credit notes payable for $1,800. Okay, so to journalize this first transaction, we've got a debit to cash for $1,800 and a credit to notes payable for $1,800. And the effect is we have increased cash and we have increased our liabilities. Okay, now let's look at what happens on June the 9th. June the 9th, we collect $1,920 from an accounts receivable from our customer, Nina Lesher. Okay, so what happens is we collected cash, so cash needs to increase. Okay, the flip side of that is accounts receivable is going to decrease. Remember, accounts receivable represents money that our customers owe to us. So if a customer pays us cash, then they owe us less money, okay? So we need to increase the cash account and decrease the accounts receivable. Well, both of these are asset accounts, so we're just going to look right here. We post a debit to increase and a credit to decrease, which means we're going to debit cash for the $1,920 that we received, and we're going to credit accounts receivable for the same $1,920. Okay, back over here on June 10th, we purchase $180 of inspection supplies on accounts. Supplies are an asset, okay? So we know that our supplies are going to increase by $180. Now, this is a little tip for you. Anytime you see that we've purchased something on account, that is a red flag that we are looking at accounts payable, which means we are going to pay it in the future. So in this case, we need to increase our supplies, which is an asset, by $180. We're also going to increase our accounts payable, which is a liability, by $180. Okay, to increase supplies, which is an asset, we're going to post a debit of $180. To increase accounts payable, which is a liability, we're going to post a credit of $180. Okay, so that transaction, we've debited supplies, credited accounts payable for $180. Okay, I'm going to scroll down a little bit here. All right, let's look at the 17th. Billed homeowners $1,980 for inspection services. The entire amount is due on July 17th, okay? This is a very common type of transaction for businesses. Basically, they have performed some services, they have earned revenue, but they are sending those customers a bill which will be paid at a later date, meaning that we have an accounts receivable, okay? When we have earned the income, but the customers haven't yet paid us, that's accounts receivable, okay? So in this case, we need to increase accounts receivable and we need to increase revenue, okay? Accounts receivable is an asset, okay? To increase that, we're going to post a debit. So debit accounts receivable, $1,980. We also need to increase our revenue account, okay? To increase a revenue account, we're going to post a credit. So the credit goes to inspection revenue. So debit accounts receivable, credit inspection revenue, $1,980. All right. On June 25th, we paid $240 for ads to be aired on June 17th. In this case, we have an advertising expense, okay? And I'm going to give you a tip here. Anytime we have transactions involving expenses, we really have two choices. Either we pay the expense in cash or we incur the expense and we're going to pay it at a later date, meaning that it's going to be a liability for us, okay? But the transactions are always going to be set up the same, okay? To increase an expense account, you're going to debit it, okay? So anytime we have an expense, you're going to debit the expense account, okay? The credit is the only thing that will differ. If we pay the expense in cash, which is what we did here, the credit goes to cash. If we are going to pay the cash later, meaning that we have an accounts payable, then the credit would go to accounts payable, which is a liability, okay? And if a liability increases, that's a credit as well. So basically, anytime you have an expense transaction, the debit's always going to go to the expense account. The credit is either going to go to cash or accounts payable. If you pay it in cash, the credit goes to cash. If we're going to pay it at a later date, or for example, they tell us that we got the services on account, then we know it's accounts payable and the credit would go to accounts payable, okay? And we're going to use the same approach for the next two transactions. In this, on June 28th, we've got $1,560 in testing expenses, and in this case, they paid it. So we're going to debit testing expense for $1,560, credit cash for $1,560. June 30th, recorded and paid salaries of $1,320. We are going to debit salary expense $1,320, credit cash $1,320. Okay, and this is the same approach that you'll always use to journalize transactions. It will get much easier as you go once you kind of master the rules of debits and credits. But until you have those rules mastered, just keep a little chart like this handy, a little cheat sheet, if you will, that you can use when you're posting and journalizing transactions. Okay, so now that we have journalized all of these transactions, the next thing that we're going to do is post them to the general ledger. Okay, I'm going to have to scoot over a little bit for you guys to see the general ledger, so give me just a second here. Okay, so basically a general ledger is nothing but a list of all of the accounts within the chart of accounts, and this is where we are going to show our balances, and we are going to post each of the transactions that we record so that we can always calculate a running balance, okay? Now, in the real world, this would all be done electronically, but in textbook world, we use T accounts to represent the general ledger accounts, okay? So let's just look at one, for example. Let's look at cash. Okay, so cash, we know from the beginning trial balance that we started with a balance of $6,120. So that's our beginning balance. Okay, and we know that on June 4th, we can go back to, I'm just going to scoot over for a second, we can go back and we debited cash for $1,800. Okay, so you can see the debit here for $1,800. And we just go through each of those transactions here, each of the transactions here, and we're going to post these debits and credits to the accounts indicated. And once we do that, that allows us to compute the ending balance in each account. And the ending balance is essentially going to be, you're going to total the debits, you're going to total the credits, you're going to net the two of those together, and that is going to be your ending balance, okay? When we do this in cash, and let me see if I highlight these, if you'll be able to see it. Oh, yes, you can. Look at this. See, the sum of all of the debits is $98.40, and then we go over here. The sum of all of the credits is $31.20. The net of those two is going to be $67.20. And the debits are higher, so it's a debit balance of $6,720. Now, you'll notice over here in accounts that carry a credit balance, we're going to have a credit balance, like accounts payable. You'll also see that with revenues. So basically, once we've posted all of the transactions, we can compute our ending balance. And once we compute that ending balance, we are ready to scoot over here and prepare our trial balance. Let me see if I can get this on the screen a little bit better for you. There we go. All right. And so we're just transferring all of those ending balances that we just computed for each account. This allows us to prepare our ending trial balance. And when we add our total debits and our total credits, they should come to the same amount.